recognizing the fair value of the options. Compensation now is measured as the fair value of the stock options at the grant date, not the exercise date. We record that amount as compensation expense of the service period for which employees received the options. The fair value is estimated by employing a recognized option pricing model. An option pricing model takes into account several variables such as the exercise price of the option, expected term of the option, current market price of the stock, expected dividends, expected risk-free rate of return, expected volatility of the stock. But anyway, these are the finance area, and normally if you take CPA exams, they are provided in the question. You don't have to calculate those variables. At January 1st, 24, Universal Communications grants 10 million options to key executives. The options permit recipients to acquire 10 million of the company's $1 per common shares within the next 8 years, but not before December 31st, 27, the vesting date. The exercise price is the market price of the shares on the date of grant, $35 per share. The fair value of the options, estimated by an appropriate option pricing model, is $8 per share per option. So let's calculate the total compensation first. On January 1st, 24, there is no entry. Estimated fair value per option is $8 times the total options granted, 10 million. So the total compensation is $80 million. It's allocated to expense over the 4-year service period, 24 to 27. So it's $80 million divided by 4 years. The compensation for each year is $20 million. Journal entry for the end of each year is debit compensation expense, 20 million, and the credit paid in capital restricted stock, 20 million. A forfeiture rate of 5% is expected. In that case, for each year, the compensation expense will be 80 million fair value times 95%. This is 100% minus the forfeiture rate 5%. So it's 95% divided by 4. So each year the compensation expense will be credited by 19 millions, and paid in capital stock options will be credited by $19 million. If the expectation changes, Universal should adjust the cumulative amount of the compensation expense recorded to date in the year the estimate changes. For example, during the third year, Universal revises its estimate of forfeitures from 5% to 10%. The new estimate of total compensation would then be $80 million times 90%, which is $72 million. For the first 3 years, the portion of the total compensation that should have been reported would be 3 out of 4, so times 3 divided by 4. So it will be $54 million. And since $38 million of that was recorded in 24 and 25 before the estimate changed, so an additional 16 million will now be recorded in 26. So this is how we get the number. It's 54 minus 38, which these 38 are recorded in 24 and 25. So now we need to record another $16 million in 26. Then, if the estimate is not changed again, the remaining $18 million will be recorded in 27. That is 72 million. This is how we get the 72 million minus what we recorded so far, 54. So $18 million will be recorded in 27. Alternatively, the company can choose to record forfeiture when it actually incurred. So in 26 options with a fair value of $8 million when granted are forfeited due to executive turnover. So this is in the third year. The first 2 years journal entry will be the same. Compensation expense debited $20 million. And let's see 26. In 26, we know that $8 million are forfeited in this year. So for cumulatively, I say 80 million minus 8. So the total amount should be $72 million times 3 years accumulative over 4 years period. So 3 over 4 minus 2020 that were recorded in previous years. So in 26, compensation expense should be recorded by the difference, which is 14. And in 27, now it's 4 over 4 years. So it's 72 million times 4 over 4 years minus which was debited in the previous years. That's 20 in 24, 25, and 26. So we get the difference. Remaining amount is $18 million compensation expense in 27. Half the shares, 5 million, are exercised on July 11/30 when the market price is $50 per share. So the journal entry will be debit, cash, received is, okay, so it's indicated here. The exercise price, 35 per share times 5 million shares. So cash will be received 175. And paid-in capital stock options will be debited by 14 million because that's half of the account balance, which is 18 million divided by 2. So it's 14 million reduction. Common stock increased by the par value times total shares exercised. So it's 5 million. And the difference will be credit to the paid-in capital excess of par by 210. That is 375 plus 40 minus 5. If the remaining 5 million options are expired without being exercised, journal entry will be reduce paid-in capital stock options 40 million, that's 80 divided by 2. All right. And the credit paid-in capital expiration of stock options 40. Differences between IFRS and the US GAAP. So recognition of deferred tax asset for stock options. Under IFRS, the deferred tax asset is not created until the award is in the money. So that is, it has intrinsic value when it is in the money. The addition to the DTA is the portion of the intrinsic value earned to date times the tax rate. Plans with graded vesting under IFRS, the straight line choice is not permitted. Also, there is no requirement that the company must recognize at least the amount of the award that has vested by each reporting date. So this is the difference.